All right, so have you been trading the markets recently? You've just blown your trading account, you're feeling super frustrated, you feel like trading isn't working, it may not be for you, but the truth is, if you haven't been taught about risk management strategies, how to protect your account from losses, which is just inevitable when you're trading, is part of the process, then it's not your fault, and I want to show you something that will completely transform your trading. Because there is an amazing stat that 90% of traders lose 90% of their money within 90 days of trading. So why is that? It's because traders have never been taught how to calculate how much of their account to risk on a position and exactly ways to place their stop loss based on historical volatility. So let's say you're day trading and you're getting into a trade in the currency markets. Your stop loss is 20 pips away. You don't even understand that Euro USD, for example, fluctuates on average by nearly 0.5%. That's 70 pips from where you get into the market. Your stop loss has to be to make sure that the market has enough room to fluctuate without getting stopped out of a trade. Same for gold, same for stock market indices. They all have different levels in percentages where your stop loss has to go based on hard data. So when I take you over to the computer screen, I'm gonna show you, going back over 10 years, how much an asset fluctuates. So you know where to place your stop loss if you're a day trader, a weekly trader, or a monthly trader. And then I'm going to show you a simple calculation to know how much to place on a trade based on where your stop loss is, based on the historical volatility that you will be analyzing. So you will know that every time you get into a trade, you're not going to risk more than, say, 5% of your account. Or if you want to risk maybe 10%, it'll be capped at that amount. So if you lose a trade, you're not going to blow your trading account. Once you learn this, I promise you, it will transform your trading. You will be able to trade safely, in confidence, and you'll never, most importantly, blow your trading account again. So come over to the computer screen, enjoy this video, and learn how to manage your risk. All right, everyone, so warm welcome to this video. I'm so excited to show you about risk management. After you watch this video, you will never ever blow your trading account again. I'm gonna show you how to manage your risk. If you're a day trader, weekly trader, monthly trader, you're gonna know exactly where to place your stop loss, exactly where to place your take profit targets. I'm gonna show you how you can only win 50% of your trades, still make money, very good money, and I'll even show you, you can even only get a 30% win rate and still break even. All right, I'll also show you the historical volatility for currencies, for indices, for commodities, crypto markets. And once you got this data, trust me, I'm going to show you how it works in real time so you'll know exactly how to manage your risk. So firstly, when people are trading the markets, the most important thing that they do not understand is how much of their account they are risking on a trade. So if you have blown your trading account before on one trade or two trades or three trades, because your risk, how much you was risking on that one trade was just way too much. Okay, so let's say you had a 10,000 account, for an example, you placed 3 trades and you blew your account. That's because you didn't realize that you was risking up to 40% on every single trade. That's why you blew all your money. So let's say you got a 10,000 balance, you lost one trade and you lost 4,000, you're now down to 6,000, you lost a second trade, you lost another 4,000, you're only down to 2,000, and then you hit another trade and it goes into a loss and you've blown your account. You've lost more than you put in. Sometimes you can owe brokers more money than you've deposited, and that is a reoccurring theme that a lot of traders unfortunately go through. If you're trading 20% of your account on a position, it takes 5 trades in a row and you've completely blown your trading account. Okay? The lower down you go in terms of how much you risk, the more you're in the game. And this is why I teach all of my members when they're trading, how do you make sure that when you lose a trade, which is inevitable, it's part of trading. Even the best hedge funds lose money some years, okay? So don't beat yourself up, don't get upset, but it's because you're risking a lot of money that you've been losing a lot. So if you go down the scale in terms of how much you're risking, let's say you're only risking 15% of a 10,000 account, it now takes you 7 trades in a row before you blow your trading account. You go down to 10%, it takes you 10 trades in a row. You go down to 5%, which is actually where I trade in terms of how much of my account I risk on a position. I have to lose 20 trades in a row before I blow my money. I used to trade on a 2% risk because I was learning and getting better as I got older, and that would have taken me 50 trades in a row before I blew my account. But as I've got better and I've learned a lot about trading, I have now increased my risk. Sometimes if I'm super confident on a trade, I'll go up to 10%, but I actually break down the trade into 2 positions. So I'll enter a trade first, let the first trade get into a profit, then I'll enter the second 5%. All right, so risk management is key. So the only reason you've been blowing your account before, you was in this bracket up here, which is very, very dangerous, okay? But let me show you something called risk to reward. Now, this is how I learned investment bankers trade, hedge fund managers trade, professional money managers, they use risk to reward. And risk to reward is a very intelligent way of making sure that no matter how much you decide to risk, some people like to take more risk than others, but if you aim to make, on average, a 3-to-1 risk to reward, let me show you the numbers, okay? So let's say you got a 10,000 account, you're risking 20%. So if you lost a trade, you'll lose 2,000. But if you aimed to make 3 times as much as a losing trade, you'd make 6,000. So let's say you have a 10,000 account, you win your first trade, you've made 6,000. And now let's say you lose your second trade and you only lose 2%. So now your profit's gone from 16,000 down to 14,000. Let's say you take 10 trades in a row, you only win 5 positions and you lose 5 positions, but because you've made 3 times as much from every winning trade as you did from your losses, you'd be up 200%. That's if you're risking 20%, all right? So you lose a trade, you risk 20%, you win a trade, you make 60%, all right? Now, 20% to me is way too high. So let's say we scale down to 15% and you do exactly the same. You take 10 trades, all right, so on a 15% account, that's a 1,500 of a 10,000 account balance. And if you're winning a trade, you're making 3 times as much, 4,500. Again, only a 50% win rate. How much are you up? 150%. All right, now let's take it down a scale, down to 10%. Same situation. If you're risking 10% of 10,000, you're risking $1,000. But if you win a trade, you're making $3,000. 10 trades, 5 winners, 5 losers, 50% win rate. You're still making 100% return on your money. You're doubling your money. All right. Obviously, the further down the scale you go, down to 5% risk, you're making less on a winning trade and you're risking less. But again, the same ratio applies. You take 10 trades, you lose 5, you win 5, you're still making 50% return on your money. Okay, go down to 2%, same scenario. You're risking 200 of a 10,000 account, but you're making 600 on a trade. You only have a 50% win rate, you're still up 20%. So this is how the professionals trade in the markets. And I'm going to show you how to actually know exactly where your stop loss has to be if you only want to risk, say, 5%, 10%. And I'll show you exactly where your take profit has to be if you want to get into a trade, which is a 3-to-1 risk to reward. Now, the most important thing when they're using risk reward and risk management is, where do you place your stop loss? Because when people get into trades, they don't know where to place your stop loss, and that is what can be damaging. So for an example, you're trading Euro USD. I know many of you watching this video, you're probably day traders, right? And let's say you get into a trade and you're always having a 10 pip stop loss or 20 pip stop loss, right? Which is literally minute. I trade on a daily time frame because you want to get a bird's eye view of the markets. So if you've been doing this and say your stop loss is 20 pips, which is literally here, and you keep getting stopped out the trade and you're wondering why, well, look at the candles on a daily chart. Look how much they can move in a single day sometimes. The currency can go up 2% in a day. That's 200 points. So what we have to understand is, how do we calculate on average how much does Euro USD fluctuate over the past 10 years, for an example? And this hard data is really important because you cannot argue with the numbers, okay? And this spreadsheet is literally calculating the daily volatility of Euro USD. So look, we have data from 2023 all the way down to 2013. Look at all the data, okay? And this spreadsheet is calculating exactly how much the currency pair fluctuates on a daily basis. So we have the volatility over a 1 week period for a daily basis, over a 1 month period. You can go out over 3 months, 1 year, and 2 years, right? But you can see they're quite similar. Volatility has come down for the currency pair over time, all right? But what we do is we take the past 1 week and the past 1 month, we add them together and we divide it by 2 just to get the average, okay? And look what the average says. Euro USD stop loss has to be 75 basis points, which is 0.75%, 0.75%. Your stop loss has to be that far away when you get into a trade on a daily basis to make sure you don't get stopped out of a trade. That's the daily fluctuation on Euro USD. So how many points is that if we're getting into a trade? 0.75, 78 pips. Immediately you're seeing why you're getting stopped out of the trade. All right. And volatility actually changes over time. And I'll show you in these spreadsheets. So this is the latest data in the spreadsheets that you guys will get the data to. But look at Euro USD back in 2020. It was lower. The volatility was only 0.42%. So your stop loss back in 2020 had to actually only be 0.42. At that time, it was 45 pips. But now volatility has increased. You have to move your stop loss further to make sure that you give the market the room it needs to fluctuate. Okay. Now, if you're more of a swing trader and you're trading over a weekly time frame or a monthly time frame, same thing applies. Look at Euro USD weekly volatility. Your stop loss has to be 1.85%. And again, we're just taking the last 3 months and 6 months and dividing it by 2, 1.85%. So if you've been trying to swing trade and let's say your stop loss has been 1%, 100 pips away, you didn't even understand, it had to be 1.85 minimum to give the market breathing room to fluctuate without you getting stopped out of a trade. All right. So 1.85%. And look where it was back in 2020. It was 1%. So can you see how volatility's increased on the weekly basis, the same how it's increased also on a daily basis? Okay, see, it was 0.42% back in 2020 and now it's 0.75. Back in 2020 it was 1%, now it's 1.85%. If you're a monthly trader, you want to catch big moves in the markets, which is how I trade, the stop loss has to be 4.75% minimum on a monthly basis. This is where your stop loss has to be. You cannot argue with the numbers. You cannot try to place your stop loss wherever you want to be, because if you do, you're going to get caught out of the market. And I know the reason you're watching this video is because you've blown your trading account and you've been getting frustrated and you're probably thinking to yourself, my strategy doesn't work. And it actually may have nothing to do with your strategy. You just didn't know where to place your stop loss. So look, 500 points is where your stop loss has to be on a monthly basis to let the markets breathe when you're in a trade. Where was the volatility back in 2020 on a monthly basis? 2.2%. Volatility on a monthly basis over a 2-year period has doubled. So do you see how you have to have constant updated numbers to know where to place your stop loss, because markets mature and volatility changes. It happens all the time. Okay, a lot of the volatility is down to COVID when the markets have big moves. Okay, so now maybe in the next 1 year, volatility may go down. It may increase. Nobody knows. And that's why these spreadsheets, which update the numbers, can really keep you in the game and make sure that you're not losing trades. Okay, so let's say we want to get into a trade. Remember, I was showing you the 3-to-1 risk to reward, which is very, very key when you're trying to identify high quality trade ideas. So what we're going to do, we're going to go and have a look at this spreadsheet. Okay, and this spreadsheet has all the numbers for all the currency pairs, all the euro currency pairs, all the dollar currency pairs, the pound currency pairs, the yen currency pairs, all the major stock market indices, the major cryptocurrencies, and all the major commodities. You're going to have in the spreadsheet the volatility for everything. Whether you're a day trader, which is the first number out of the 3. If you're a weekly trader, it's the second number out of the 3. And the third number if you're a monthly trader, a big swing trader, which is how I trade. I like to catch big moves in the markets. All right. So now, remember I showed you at the beginning, how much of your account are you risking on a trade? And I was showing you, you need to come down to these lower numbers to be in the game longer, because everyone loses trades. You may lose 2 trades in a row, but you don't want to be this guy who ends up getting blown out of the markets because you lose 2 or 3 trades and you've lost 80% of your account. You cannot be there. So let's say we take you down to a smart risk management around 5%, right? How do you calculate how much of your account is 5%? And then how much do you put on the trade in terms of a lot size to make sure that you only risk 5%? All right, so this is how we do it. We come up to the spreadsheet. Let's say your account is 10,000. It doesn't matter. Let's say your account is 2,000. You literally come in the spreadsheet, you punch in the number, and below is how much you want to risk. All right, so I put 5%. You may say 10%, right? So 5%, right, of a 2,000 account is 0. The calculation is 5 divided by 100 gives you 0.05. And then to work out how much 5% of 2,000 is, you're just times in 0.05 by your account balance. It's all done automatically on the spreadsheet. So if you want to get into a trade for Euro USD, for a prime example, Let's say the stop loss has to be 4.75% if you're a monthly trader, as an example. That's 504 pips. That's where your stop loss has to be. But how much do you put on the lot size to make sure that you don't risk more than 5%? Well, the spreadsheet spits out the answer for you. It's 0.2. 20 pence on that position would be how much you're risking. All right. And to show you that I'm right, let's do 0.20p times 504 pips. If the market goes against you, you've only lost £100, which is 5% of your 2,000 account balance. Again, if you're trading a bigger account balance, it doesn't matter. You put your account balance in there and it spits out the answer for you when you're getting into a trade. All right. So look, you can see that the lot size is now increased to £1 a point. So again, if you've got a bigger balance and you're trying to calculate the lot size, it's the same thing. You're doing 500, which is 5% of 10,000, divided by 504 pips, 0.99. That's nearly £1 a point, spits out the same answer. So you know exactly how much to place on a trade when you're getting into the market, right? So that's how you know exactly how much to place on a trade. Once you get that answer, it doesn't matter if the market violently moves. It doesn't even matter if the stop loss is 1,000 points. It literally automatically calculates this lot size for you. Look, if it was 1,000 pips away, well, then you just do 1,000. You literally just type in here how many pips it is, 1,000. Now it's telling you you're doing 50p a pip, all right? And you guys know on lot sizes, that'd be 0.05. All right, so now this spreadsheet spits out your answer. And if you're doing 3-to-1 risk to reward, so let's say you are taking a weekly trade for Euro USD, you're a swing trader, 1.85%. We know the stop loss has to be 1.85%. That's where our stop loss has to be. All right, there we go. So we need a 3-to-1 risk to reward. So look, it's 196 pips. 196 stop loss, just times that by 3. So I'll take profit. Has to be, to get that 3-to-1 risk to reward, to make sure we don't blow our trading account, 588 pips. So you're going to catch a nice big moves, but that's your 3-to-1. Okay, you can come onto TradingView, use this chart. It's beautiful. It literally does everything for you. So it's really easy. So your take profit has to be around here. Okay, that's a 3-to-1 risk to reward. Now, the reason why this is so important to use this is because if you don't update the data, you don't have the numbers that are changing. This is why it's so difficult to trade. It's literally virtually impossible. And to make a key point for all of you who've been day trading and you've been having a 20 pip stop loss, for an example, and you haven't been using a risk to reward of 3-to-1, the reason you find it so difficult day trading is because if you haven't been using a 3-to-1 risk to reward and you've been having a stop loss of 50 pips and a take profit of 50 pips, well, then you just have a 1-to-1 ratio. So if you win a trade, you make some money. If you lose a trade, you lose money. You're just going back and forth. You're never allowing your account to grow by using that risk reward in your favor. But the most important thing to remember, if daily volatility in Euro USD, right, is 0.75%, and you don't aim for a 3-to-1 risk to reward, you know you can't make money consistently, but more importantly, how are you going to make a 3-to-1 risk to reward on a daily basis if the spreadsheet spits out the answer that it only fluctuates by 0.75%? Think about it. You can't aim for a 3-to-1 risk reward on a daily basis if it doesn't move by a 3-to-1 on a daily basis, which is sadly why 90% of people who day trade lose money, because they just don't understand volatility. They don't understand risk to reward. They don't understand risk management. That's why you've got to increase your time horizon and trade over longer time frames. All right. I mean, I'm also going to show you how incredibly accurate these numbers are. So this is the S&P 500 US stock market, and we're going to look at this S&P 500 and we're going to compare it to cryptocurrencies, and I'm going to show you how they move literally 1-for-1. The correlation between these two is frightening, right? Let's take Ethereum for an example. So stock markets and crypto move at the same time, right? And I'm going to show you in this spreadsheet just how amazing this actually is. So you can see during 2021, the stock markets were booming after the COVID crash that happened. Okay, stock markets were going up, but exactly the same time, crypto was going up. So you can see the line on the chart on the right-hand side also lines up to the chart on the left-hand side. So you can see the correlation between the two. So we've got a spreadsheet here going back to 2021 when the markets were moving higher. The monthly volatility of the S&P 500 at that point was 5%. That's how much the S&P fluctuates on a monthly basis. The cryptocurrency spreadsheet that we had for that same period of time was telling us that Ethereum, as you can see the data's here, Ethereum was fluctuating between 40 to 50%. So on average, 47%. Now watch how amazing this is. So remember, cryptocurrency, 35 to 50%, the stock market, a 5% move on a monthly basis. Now look at the correlation between the two and how, if you understand this correlation, and how these spreadsheets would have saved you from losing money, but would have helped you made a lot of money if you was trading crypto. All right, so let's have a look at the two charts. Okay, 2021, we can see the US stock market was on its way up, and then we had some pullbacks in the market. The first pullback in the S&P 500, we had a 5% move lower, 5.9%. How much did the spreadsheet tell us? 5%. At the same time as the S&P 500 pulled back, how much did Ethereum pull back? 36%. What did the spreadsheet show you? Between 35 to 50%. So when the stock markets pulled back, so did crypto. Normal. Stock markets went up again, and then we had another pullback here in the stock markets. Can you see here? Stock markets came down again by around 5%. Normal. How much did crypto go down? 50%. But that's normal. That's how much the cryptocurrency actually fluctuates. Stock market went up again. Okay, we had another pullback here in the stock markets. 5% pullback. Ethereum had a normal pullback of around 30%. Absolutely normal for its volatility. The stock markets rallied higher again. We had another pullback in the stock markets. Again, pullback of around 5%. Totally normal. How much did crypto go down? 35%. Stock markets peaked and then went lower at exactly the same time as crypto. And we've had a bear market in the stock markets at exactly the same time that we've had a bear market in crypto. So what's my point? The point is, remember when I was telling you where to place your stop loss? So during these periods of time, if you was using fundamental analysis to know that the stock markets were going to go ahead and move upwards, well then when the markets pull back 5%, you would have entered a trade here with a 6% stop loss. Would you have got stopped out? Nope, the markets would have rallied higher. Same with cryptocurrency. When it came down 35%, you would have known it's just a normal pullback. It's within its monthly volatility. You could have bought Ethereum with a 35% stop loss or 50% stop loss on average, right? Again, you would have caught the move. Stock markets rallied up again, had a pullback. You would have bought at the bottom here of the 5% because that's literally where you wait for the market to move because you know it's a normal volatility. You jump in, buy the stock markets. Same with the crypto markets. When crypto went down by that much, you would have just moved your stop loss to 50%. You would have caught the whole move up. You could have done that over and over and over again. All right, so it's really important because when you have this data, you know how to place your stop loss. You know how to place your take profit. You know how to calculate your lot value based on where the spreadsheet is telling you how much to place on a trade based on what the chart's telling you in terms of how many pips away the stop loss is to calculate your lot size. So do you see now exactly why you've been struggling to trade? Because you didn't have this data. This is key. Without this data, honestly, you cannot trade. You can't trade daily, you can't trade weekly, you can't trade monthly. It's virtually impossible because you don't have the numbers. All right, so this is why I really wanted to help people who are struggling to trade, they're feeling frustrated. As I said in the beginning of the video, it's not your fault. It's not your fault. You've never been educated on this. When I learned this, never blew my trading account again. My account constantly grows. And I showed you 50% win rate, you're still making money. On a 3-to-1 risk to reward, you can only win 30% of your trades and you don't even lose any money. You break even. That's the power of risk management. So if you guys would like to get this data, you're going to be able to come and you're going to be able to get the data for the euro, the USD, the pound, the yen, all the indices, crypto, commodities. You can come over to kainsmarkets.com. You go to pricings page. You're going to come over, you're going to go to risk management, And I'm going to update the spreadsheet for you every 6 months, okay? So you're going to pay $149 every 6 months to stop you from blowing your training account, all right? So it's very cheap for how much it will cost you if you don't have this data. So it's a subscription, but you can cancel the subscription once you've purchased. It's absolutely fine. Come over here, you're going to sign up, okay? You're going to enter an email address and a password. Once you've entered your email address and your password, you're then going to log in, okay? You'll then be able to make the purchase on the website. You can make the payment. Once you've made the payment, you'll press the login page. It will take you into the website, and right here is your baby, risk management. Click view, and you're gonna have the download, and you'll never, ever, ever blow your training account again. And then to help you guys, I'm gonna give you 1 month's free membership to my private Telegram channels, where I've got thousands of members who are training alongside me. I'm educating them on what's driving the markets, really digging deep into the fundamentals, because when I'm trading the market, it's all macroeconomic data. I'm telling the markets, how do we understand where the US dollar is going based on hard data? So we're looking at inflation numbers. We're looking at what's happening with the employment data in the United States. Where is the bond market going? There's a video on my YouTube channel explaining the bond market. It literally is the #1 driver of currency markets, because interest rates drive currencies. So we look at where interest rates are going in the United States. We look at where the major economic data is. We get the COT reports that tells us how much institutional money is invested in the dollar. So we know if the big investment banks are long or short, and hedge funds is beautiful. You get 1 month free when you come over and you get this spreadsheet. Most importantly, guys, once you take this spreadsheet download, please message me and tell me how it's helped your training, because I cannot wait to hear some of your success stories, because it makes me feel so happy that I've been able to help people, which is really what I want to do, because I lost so much money because I didn't understand this. I once, when I first started trading, lost over £25,000 trading my own money because I didn't understand this, and it was so frustrating, all right? But it was a lesson. I had to learn it, and as soon as I learned this, I never lost a training account again. And that is the key importance to using risk management. All right, everyone. So thank you so much for coming over. Safe trading, and I'll see you in the Telegram channels.